After spending most of 2014 and 2015 in the Bow Wow Chateau, Zillow, the online real estate kingpin that's the web's biggest repository of home values and home listings, finally seems to be getting some real traction here. Stock's up over 10% in 2016. And a big part of this rally has to do with the fact that when Zillow reported earlier this month, they painted a very bullish picture with their forecast for the rest of the year. Now, when the company reported 2 weeks ago, Zillow delivered a mixed quarter, a wider than expected earnings loss coupled with higher than expected revenues, up 25% year over year, over 156 million average monthly uniques. But crucially, management gave strong guidance for the next quarter and then raised their full-year forecast for 2016, which is why the stock caught fire, up 12% the next day. So can Zillow keep roaring? Let's take a closer look at Spencer Rascoff, the CEO of Zillow Group, find out more about what the company's doing and where it's headed. Mr. Rascoff, welcome back to Mad Money. Good to see you, sir.
Thanks, Jim. Good to see you.
Spencer, is it true that now you put in Zillow into Google more than you put in real estate if you want to know what's going on?
It is true. More people type the word Zillow into Google than type the word real estate into Google. I mean, the Zillow brand has become synonymous with real estate, which is amazing.
Okay, well, that's fabulous for growth opportunity. Obviously, your revenue much better than expected. When does that translate into profit?
Well, we're a hyper-growth company right now, so we, like many other high-growth tech companies, are in revenue growth and sort of market share gain mode rather than profit maximization. We've told investors that we think when we're at revenue scale, which means a slower revenue growth rate, maybe 5 to 10% revenue growth rate, then we can achieve 40+% EBITDA margins. Okay. And that's real net income at that point as well.
We are seeing a lot of deals being nixed by the government. It's very interesting because the government held up the Trulia Zillow merger.
They did.
It looked like that was, in retrospect, somewhat of a setback, but now you're back where you thought you might be. Is that a good depiction?
Yeah, I mean, it took the Federal Trade Commission about 10 months to approve the Zillow-Trulia merger, and I'm very grateful that they did, and we're firing on all cylinders as a result. So today, Zillow Group has 5 consumer brands: Zillow, Trulia, HotPads, StreetEasy, and Naked Apartments, and the combination of that audience across all those brands are the reason that we're killing it. So we have such a huge audience now that if you're a real estate agent or a mortgage lender or a home builder or a property manager of a rental, you want to advertise with Zillow Group to reach that huge audience across all those brands.
Okay, what happens if Realtor.com says, look, we're a better place to go?
I guess a competitor could say that, but that would be untrue.
All right, well, but they have a lot of money, and they're doing a mockumentary of you. I mean, they've been after you for a while, and they do have deep pockets.
I mean, they're owned by Rupert Murdoch and News Corp, and they've got some dough for sure. I mean, for us, we control our own destiny. Okay. So, we're now 10 years into this journey. There's this huge addressable market, tens of billions of dollars of advertising spent in and around the home. And we've got the brands, we've got the audience. So competitors will do what they're going to do on the business battlefield and in the courtroom, and we're going to do what we're going to do.
Well, you brought up the courtroom. Susquehanna comes out today and says there was a ruling, and the ruling was very bad, and you should sell Zillow because it looks like that it validates one of Zillow's key top executives that he acted with willfulness and bad faith in destroying evidence. That sounds like something that's not so positive for Zillow.
That was a patently bad and inaccurate analysis of a judge's verdict. So yesterday, the judge ruled on a pretrial motion, and he ruled dramatically in favor of Zillow Group, and that analyst just got it wrong. And you see, when the analyst got it wrong, the stock went down today, and then once the market realized that the analyst was just wrong, the stock went back up.
But the legal expenses are so big here.
They are high. Look, we're a defendant in a case, and we got to defend ourselves, and lawyers are expensive. So it hasn't, fortunately, impacted our business results. I mean, we're still killing it. We're growing rapidly. But, there's no question that we're spending a lot of money defending ourselves in this lawsuit. And it's just a shame, really, that,
It's the system.
Yeah, it is the system.
I have to agree. It is the system. Now, emerging marketplaces, both mortgages and rentals. Talk about them, because in the time since I've known you, these have gone like this.
They have, and this is a good example of what we do at Zillow Group. Okay. We plant seeds that sometimes don't bear fruit for 5 or maybe 10 years. And when we started investing in mortgages 5+ years ago, we made a decision. We said, instead of just outsourcing our mortgage business to somebody else, hey, let's try to build it up ourselves. And now today, it's a big business and it's growing really rapidly. We're doing the same thing again with rentals.
But there's no credit risk.
No, of course not. We're an advertising company, so we're not an originator.
That's important because a lot of guys take
You're right. We're not a mortgage originator. We're an advertising platform. So mortgage lenders advertise with us to connect with borrowers, either purchase loans or refinance loans. With rentals, we have an even bigger opportunity than mortgages, and that's because really nobody has cracked the code on rentals, both with apartment listings but also single-family rentals, which is what is most of the rental inventory in the U.S. So we're heavily focused on it. We've made a number of acquisitions, and we are already the largest rental site on the web. Over over 30 million people use our different sites to shop for a rental every month. So we're the biggest rental site
How's
out there.
the margins on rental?
Well, they're not there yet because we're still building it out.
Okay.
So we're hiring sales staff, we're growing audience, we're innovating on the product, but eventually this will become a big business that will be high margin.
Okay, let's talk about the housing business in general. Are there, it doesn't seem to matter how many transactions there are. You've still been growing without that.
Yeah, we're a media company, so we do well sort of through different
Mm-hmm.
stages of the cycle. What's happening with housing overall is the rate of appreciation has slowed a little bit. So now we're seeing home values increasing 4 to 5% year over year. Our economists forecast, and our survey of about 200 leading housing economists forecast about a 4% rate of appreciation over the next 12 months. So as a result of limited inventory, that's why home values are increasing.
Okay, Street Easy is an amazing product. If if New York peaks, will it hurt your business? Because I mean, geez, you guys own the city.
Street Easy is an amazing brand. We acquired it a couple years ago. We just acquired Naked Apartments, which was the largest independent rental site in New York. So between those two brands, and then of course Zillow and Trulia, we really have a premium position in terms of New York home shopping. I'm not worried about if there is a downturn in New York real estate, which so far New York has been impervious to any kind of downturn. I don't worry about its impact on Street Easy. The opportunity for us is so huge as ad budgets move out of print and into digital that just in the New York area.
There's still a lot of print.
Can you believe it? But print, direct mail, outdoor advertising, I mean, it's still, for overall in the real estate category, it's billions of dollars, and in New York, it's hundreds of millions. So eventually those budgets will move online, and I believe they'll move to Zillow Group because we have a collection of brands.
This is a paper to digital internet world, and you're the winner. Okay, well, Realtor.com doesn't agree with that, but certainly for share, you're definitely the winner.
Thanks.
That's Zillow Group CEO Spencer Rascoff coming off a really good quarter and great revenue growth. Mad Money's back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.